Welcome back to the Dividend Diplomats YouTube channel. You know you got your boy Bert the Herd over there, and you know you're rolling with Lanny, Big L, the Dividend Diplomats, and we're here to talk to you about two undervalued stocks to buy right now.
Absolutely right, Lanny. Everybody, before we jump into these two companies, please subscribe to our channel if you haven't already. Give this video a thumbs up. We appreciate all the support and we love sharing dividend news with all of you, whether we're talking about undervalued stocks to buy or our purchases or recent dividend increases, although there haven't been a lot of those recently for us to feature on our channel.
Yeah, we've been sticking with our Monday normal buys in the stock market. Hard to find a dip when the market is still crushing, very, very high. I mean, again, the S&P 500 is still soaring over 4,700 at the timing of this video, which is January 11th. It's at 4713.07. So again, in between at 4,700, 4,800. But Bert, we're here to talk to the viewers about our favorite industry. Oh no, we're not talking about tech. We're not talking about Tesla. We're not talking about Apple. We're not talking about all the other hot stocks or even crypto. We're here to talk about banking.
I was going to say WWE, but banking works a lot better too. You're absolutely right, Lanny. We both have our backgrounds in the banking sector here. It's something we've grown up with, and we are passionate about following bank stocks and finding undervalued bank stocks to buy. It's fun. It's a sector we know well, so we can parse through those financials really fast to make a quick investment decision, and that's what is exciting. And truth be told, what we like about banking is it touches everybody's life in one way or another. Everybody has an account, everybody has cards, everyone has all the products that these banks are doing. So it's great to be part of products that are going to touch your life every day. That's what we do for other stocks, and that's why we like banks.
Bert's just trying to touch lives, he's saying. So with bank, we're not talking about the JPMorgans, the Wells Fargos, Citi, Bank of America, you name it. No, we're not talking about the $1 trillion plus asset size banks. We're talking about two other beasts in the industry. We're talking about banks that are approaching 1 billion total assets and even 2 billion in total assets. So we're talking smaller regional banks that provide high quality undervaluation in this high overvalued stock market.
That is absolutely right, Lanny. And how are we going to look at these stocks here? We are going to run them through the Dividend Diplomats Dividend Stock Screener, where we talk about 3 metrics and a bonus metric here. We're going to hang tight at the end of this, though, because we're going to talk about the one slight deviation and one extra thing we're going to throw in there for banks. The first metric of our screener, PE ratio less than the S&P 500. 2, dividend payout ratio less than 60%. 3, history of increasing dividends. And 4, dividend yields. Lanny, why don't you talk about the slight deviation that we're going to use and the extra metric to evaluate undervaluation for the banking sector?
So a little education out there for investors, beginner investors, intermediate, advanced, banking and dividend investors. When you're talking about banking, you look at really not just the price to earnings ratio, but you want to look at the price to book, the market value, aka the stock price over the book value of the company. The book value is really the equity with the shares outstanding, and that equates your book value per share. And Bert, what do you want to see?
When we are looking for undervalued price to book ratios, we typically look for a price to book ratio of 1.25x or under, but the real sign that we want to see lower than that. That's the initial screen, but then we keep going down that list. We take it from 1.25 to 1.2 to 1.15 to 1.1 to 1.0, because if your price to book is less than 1x, that is a screaming sign of undervaluation in the banking sector.
Exactly. This is where one metric you want it to be low, similar to your price to earnings ratio. So again, we're talking about 2 bank stocks, and Bert and I, the Dividend Diplomats, actually own this in part of our Dividend Diplomat portfolio. Yes, we actually have one. We've had one for years, and both these stocks are on there because we're trying to add to our current positions.
I
So
also own both these companies too in my taxable account as well.
Bert and his wife actually own these stocks as well. I do not own either of these. My wife does not own these as well. But and again, the diplomats also own these stocks.
Yep.
So get into that. And Bert, I say we just run down the list on the two bank stocks we're talking about. I'll say the first one, you say the next one. We're talking about Dimeco Bank, ticker symbol DIMC.
Yep. And the other one, you're going to talk about your little PA bank all day long. I'm going to stay in the Buckeye State and talk about LCNB, ticker symbol LCNB. Yes, Lanny, I am the one here that's sticking to our roots in this analysis.
You love the state of Ohio. Gosh darn it, Bert.
I do. I have it tattooed at least 30 times on my body, Ohio, in different ways, shapes, or forms. So get ready. Mr. Buckeye here.
Hey, they call him Mr. Buckeye. They call him Brutus the Burt. The Burt, Brutus the Burt face here. So Dimeco is trading at $37 per share as of January 11th. Now, I took what their earnings was at the midpoint of the year and annualized it. It's pretty hard to find information on them because they're trading over the counter. But if you have investments at Fidelity or other brokerages, you might be able to put a limit order to buy this stock. Very tough sometimes to buy these stocks, as Bert knows about.
Yeah, so we typically use Yahoo Finance when we're looking at the average earning estimates. And for the larger companies, you have a large population of analysts that are covering the companies. For these two, we can probably count them on one hand, the number of analysts that are going in there. So I think your method of looking through the financials and annualizing, it's going to be the best source to get us an estimate.
In their short little earnings release, they didn't even say what their 9 months to date earnings per share was. So had to go back to the 6 month little blurb.
Love it.
Talk about small banking at its finest. So the annualized EPS was $4.32. That equates to a price to earnings ratio of only 8.56, very low. So what does LCNB look like, Bert?
19.96 was their closing price for the time of this video. EPS $1.55. PE ratio 12.88 there. So obviously PE ratio, Dimeco is trading at a much lower multiple there. We'll come back to the price to book ratio after we look through the rest of the metrics of our stocks here, and we'll see how that holds up with the PE ratio.
Very nice. All right, so getting into that dividend payout ratio. Now Dimeco pays a quarterly dividend of 36 cents per share per quarter, or $1.44 for the year. Taking that over the 432, pretty darn low payout ratio at 33%.
LCNB, 80-cent annual dividend, payout ratio 51.61%. Wait a second. Is that in the perfect payout ratio range of 40 to 60% that we're always looking for? Sure seems like it to me, Lanny.
Hey, you take it easy there, Chico.
Yep. Dividend growth. Talk to us
about. Hey, yo. Hey, yo. So the dividend growth, third metric. DIMC, again, Dimeco, DIMC is the ticker symbol, 5+ years of dividend growth right now at an average rate of about 7.4%. Now, there's another element to this that I'm not considering because I had to create my own calc because I remove the special dividends that DIMC pays out, which again is not factored in here and is only better for you as a dividend investor.
Yeah. Well, it's good that you backed up there so you can get the actual dividend growth rate because you can't rely on special dividends going forward. So it's good to back out and still see without that, they're growing their dividend by 7%. LCNB, no special dividend. Their recent dividend growth is actually pretty boring. They've increased their dividend for 4+ years, and they have this trend where they're increasing that quarterly dividend by 1 cent, pretty consistent. I'm assuming that's just going to keep being the trend there. So the growth rate is just going to get lower and lower over time. Their 5-year dividend growth rate is 4.6% today.
Yeah. Now, again, the 5-year growth rate for LCNB, because they've only increased it 4 years, their 1 year as a 0% that gets factored in.
Yep. And their last dividend increase was 5.3%.
Now, what I do want to make note of is Dimeco actually had a nice, big, again, whopping special dividend. In fact, their special dividend was bigger than their quarterly dividend. They announced a 50-cent special dividend this past quarter. So in total, that last quarterly announcement was 36 cents normal dividend, which was actually a 2-cent increase from the previous year. But then they announced the 50 cent on top of that. So 86 cents in that quarter coming back to the shareholders.
Excellent. Let's move to that fourth bonus metric here, dividend yield. Why don't you tell us about Dimeco's yield, Lanny?
Based on the timing of this video, the dividend and the share price, their dividend yield is a nice hot 3.89%.
And that's without the special dividend too. So when you factor in the special dividend, your yield that you're going to receive this year on Dimeco because of that special dividend is actually significantly higher compared to LCNB. Their yield is a hair north of 4% at 4.01%. Pretty comparable though.
Exactly. So far stocks this year, again, we're only in the second week, but both stocks are up year to date. Dimeco is up a little over 2%, about 2.78. LCNB is up, just under 2% at 1.78. Last 52 weeks, though, LCNB takes the cake here at 28%, with Dimeco only up about 15.5%. So Bert,
let's move into our bonus metric here, the price to book ratio. So, all right, let's do this here. Let's remind everybody to see if there's correlation between the two, the PE ratio and the price to book for the company. Dimeco's PE ratio was 8.56. LCNB's PE ratio was 12.88. So let's see, is Dimeco's price to book ratio that much lower than LCNB's to see if it matches that trend?
And Bert, I'm going to tell you straight out the bat, it matches the trend. Dimeco's price to book ratio, again, taking that market value and dividing it by the book value. The market value is $37 per share. The book value is approximately $41.39. So they're trading less than what their book value is. Now, LCNB, on the other hand, is still very nice at 1.04, where, they're trading at right now 1996 share price, but their book value is 1917. So they're trading just slightly above what their book value is.
Yep. So just remember with that too, to put it into perspective, when banks are getting acquired, their book values are easily north of 1.5x to 2x. And it might be even higher for some of them because it costs a lot to buy banks as like just every other asset. So to help put it in perspective, these price to book ratios for Dimeco and LCNB are significantly lower here than some of the other premiums for these larger institutions. And the
both show signs of great undervaluation. Now, so to summarize with Dimeco and LCNB, both of them price to earnings 8.56 versus 12.88, payout ratio of 33% versus 51%. Both have dividend growth streaks, one at 5 years, the other at 4. Dividend growth rate 7.4 versus 4.6. Yields are very nice and steady, 3.89% for Dimeco and just over 4% for LCNB. And again, the price to book ratio under 1 for Dimeco and slightly above 1 for LCNB. Bert, what do you think about these two banking stocks to buy right now?
I'll make this one pretty simple. I'm extremely frustrated how hard it's been to find undervalued stocks to buy right now. I own 134 shares of LCNB. I own 50 shares of Dimeco in my personal portfolio. I'm going to throw at least another $250 into each one of these companies here to just keep building those positions as a result.
Perfect. 2 dividend stocks Bert's saying is a buy right now.
What about you?
I have so many stocks and I'm not trying to create a new position. So I'm kind of like, dang it, I don't own these 2 yet. So we do have a little bit of money in our investment account, Bert, with the dividend diplomats. So I think we should buy both of these. I am here saying that these are, again, do your own research, make your own judgment call, but these are 2 dividend stocks to buy right now.
All right, everybody. So let us know your thoughts on these here. You see the metrics. Let us know what you're thinking of these companies. Also, please, 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 let us know what other banks you see with higher dividend yields close to 4% with dividend growth that may have low price to book, because chances are we want to look further into that company to consider if we should add them to all of our portfolios. And if you haven't already, subscribe to our channel and give us that thumbs up.
We appreciate everybody. Dividend stocks and dividend investing, as we have shown, is one of the best ways to create passive income on that journey to financial freedom. We appreciate you guys for following along. I always have to ask the question, are you not entertained? So guys,
I
again,
don't
leave
think
all
you've
your
always
thoughts.
asked that question.
No, but I'll start. So guys, leave all your
Please no.
thoughts in the comments below. That was Bert. This was Lanny from the Dividend Diplomats. Over and out.